Investment firm ARK Invest has been known for years for its eccentric company valuations. Back in 2018, CEO and CIO Cathie Wood made a monster call on Tesla, saying that the share price would skyrocket to $4,000 per share, which at the time was a 13x gain. This was when Elon Musk was struggling to ramp up Model 3 production, and Tesla was on the verge of bankruptcy, as Elon later admitted. However, ARK Invest's bold call ended up coming to fruition 2 years earlier than expected. And now the investment firms Tasha Keeney, Sam Korus, and Daniel McGuire have pooled their research together to make another insane prediction, that Tesla will hit $2,000 per share in just 5 years from now. And before we continue, stop using Yahoo Finance, stop using Google Finance, and have a look at our website, themarketisopen.com, where we have instant stock quotes and a brand new set of financial data going back 15 years, and it's all freely available. ARK Invest, an investment management company focused on disruptive innovation, just recently published a research paper on Tesla's price target for 2027. This follows ARK's typical 5-year time horizon, where they believe Tesla can hit $2,000 per share as their expected value, a 12x from the current approximately $165 price. Even in their bear case scenario, ARK sees room for the stock to multiply itself by 8 times to get to $1,400 per share, which is still a massive return in 5 years. And their bull case of $2,500 per share represents a 1,400% return by 2027. Now, these numbers tend to get lost on investors since they don't follow the traditional 12-month price target of traditional analysts. The large numbers tend to bring skepticism as they appear unrealistic or unattainable, similar to how extremely low price targets tend to be dismissed if they're too far away from the current price. And so the 5-year time horizon may be difficult for investors to wrap their heads around, but a lot can happen in 5 years. That said, ARK has one of the best track records with their predictions in Tesla, and the 5-year target comes as a benefit since it allows them to think long-term and ignore short-term fluctuations such as Tesla's vehicle pricing strategy, where they raise and cut prices all the time, leaving traditional analysts constantly on edge. Now, one thing ARK Invest has done differently this year is that they're finally accounting for the energy business. This could be because battery storage is breaking out thanks to Tesla's Megafactory in Lathrop, California, and Tesla just announced the build-out of a new Megafactory in China. ARK is looking at just storage and not solar, which is fair since solar is still in its infancy, while storage makes up about 5 to 6% of Tesla's revenue and is growing faster than automobiles. Now, that said, battery storage is still a small 2% of their EBITDA and enterprise value estimates. However, as we'll soon discuss, the majority of ARK's valuation depends on massive growth in robotaxis. And so battery storage is a real business today that Tesla is servicing. They have orders that they can't fulfill until 2025, and as Tesla scales and increases their factory utilization while cutting costs, it could be immensely profitable. And looking at ARK's revenue chart, Tesla Energy makes up just 5% of Tesla's estimated 2027 revenue, but that assumes vehicles are only 47% of the business, whereas today they're closer to 95%. So ARK is actually assuming that by 2027, storage will have grown twice as fast as automotive to become 10% the size of the auto business. Now, in their expected value case, there seems to be a huge jump in battery storage from the year 2026 to 2027. This doesn't seem to be explained other than Tesla allocating 16% of their battery resources into the energy division by that year. ARK is estimating about 200 gigawatt hours of deployments in 2027, which actually seems possible given where Tesla is today. But in the last quarter, Tesla deployed 4 gigawatt hours of battery storage, which is a run rate of 16 gigawatt hours for this year if Tesla doesn't grow at all and can maintain their current output levels. That actually makes the 2023 bar chart seem a little low, although it's not labeled. The Megapack factory that they're ramping up will have a 40 gigawatt hour yearly capacity, and Giga Nevada has also been contributing a few gigawatt hours of storage products as well, and Tesla is upgrading that factory to add even more battery production. At the same time, given the speed that Shanghai works at, Tesla's second Megafactory could begin producing battery packs next year. So ARK's 2024 estimates seem to be closer to what Tesla will do this year, and by 2025 it's likely that Tesla exceeds 50 gigawatt hours, so each of ARK's estimates appear to be about a year behind. And so if the growth is more gradual, it makes the spike in 2027 seem less aggressive. Now there are some exciting factors at play that ARK may be taking into consideration that I don't see mentioned, but Tesla has hinted at new battery products that may be announced within the coming quarters. And so if those products are more energy dense and can hit a large scale in a couple years, it would definitely contribute to higher gigawatt hour deployments. Over the next 5 years, Tesla can easily announce new megafactories as well. They can hit 200 gigawatt hours per year with just 5 factories, each producing Tesla's current megafactory capacity of 40 gigawatt hours. Tesla just needs to announce and build 3 new factories to achieve this goal. But at the same time, they can expand output at existing factories with the help of their new products. And so as long as Tesla has the battery cells available, the storage division should grow as ARK expects. Now back in 2020, which was already over 3 years ago, Sam Korus of ARK Invest updated the firm's Tesla model for 2024. The bear case called for 3.2 million vehicles, while the bull case was looking for 7.1 million units. Now that we're in 2023, although things can change, it's easier to see how close these estimates are. Tesla's aiming to do 1.8 to 2 million units this year, and if they can hit the high end of this range and grow at 50% next year in 2024, which is Tesla's long-term target growth rate, then they'll be able to deliver 3 million cars in 2024. But this is below ARK's 2020 bear case. Now that said, on the most recent conference call, the analysts were spooked with Tesla's price cuts, especially when Elon Musk said that Tesla could effectively sell vehicles at zero margin and still make money off of longer-term software products and such. But it doesn't seem like Tesla's actually doing this, at least not right now. Tesla's price cuts, as Elon Musk also said on the call, appear to be more as a function of interest rates in order to continue making vehicles affordable for consumers, even if the cost of financing is higher. So during these tougher economic times, Tesla is taking a short-term hit, it seems, which is also putting a lot of pressure on competitors to lower prices of their unprofitable EVs or to cut back on their investments, while Tesla moves full force ahead. By 2024, Elon Musk believes that the economic situation will get better, and so prices and margins could return, with Tesla having strengthened their leadership position. So this goes back to ARK's average selling prices and high gross margins, which seem to be much higher than where Tesla is as of the most recent quarter. But this could just be a reflection of the current situation, whereas longer term, Tesla returns to its higher profitability, which most analysts are only thinking about day by day versus ARK's longer term view. Looking 5 years ahead from now, Tasha Keeney, Sam Korus, and Daniel Maguire are predicting that Tesla sells 10 million cars in 2027 as their bear case and 20 million as the bull case. If Tesla grew sales at exactly 50% per year for the next 5 years, they would almost make the bear case at just under 10 million cars, which would also make Tesla the largest automaker in the world by sales, on the same level that Volkswagen and Toyota have been for so many years. But unless something drastic occurs, it's hard to imagine Tesla's growth rate accelerating dramatically to roughly 73% per year starting this year in order to achieve 20 million unit sales. Now this could depend heavily on Tesla's next generation platform and what they have in store. The key is really manufacturability, and Tesla stated at Investor Day that they're truly trying to optimize for that. They have a new parallel assembly method that's intended to greatly increase production speed by building modular sections of the vehicle in parallel. It will also be interesting if Tesla can take its innovations, for instance around motors, and removing the expensive rare earth metals while maintaining a highly efficient motor, and applying some of these changes back into Model 3 and Model Y's existing production lines to drastically cut costs. The average selling price of a Tesla, as of the most recent quarter, has also dropped to $47,000, and so a new cheaper Tesla built on the new platform could be the driver of much cheaper prices. But at the same time, there are vehicles like the Semi, and especially the Cybertruck, which has a very large market, the pickup truck market, that commands premium pricing. So this could actually keep Tesla's average prices high, though it does make sense that if Tesla wanted to get to 20 million cars, the cheaper Tesla would need to dominate sales at a $25,000 selling price. While the average price of a car hit $50,000 this year in the United States, the global average car price has been consistently near $28,000 and is also forecast to be so, according to Statista. This highlights the importance of Tesla's cheaper vehicle that's in the works and lines up with ARK's long-term average selling price converging to this level. Now, the largest component in ARK's Tesla valuation comes from robotaxis. ARK's Tasha Keeney focuses her research on this aspect, and it looks like ARK's confidence in Tesla's ability to bring robotaxis to market has never been higher. Tasha Keeney even highlights in a Twitter post that more Tesla vehicles on the road will boost robotaxi recurring revenue, and this cash flow will be higher than that of electric vehicles themselves. ARK's estimates for 2027 attribute the greatest earnings per kilowatt hour to robotaxis, which of course makes sense as it's purely a software-based business with high margins. The real question is if Tesla can indeed bring robotaxis to market, and while Elon Musk has once again stated on the most recent conference call that it could happen this year, ARK is only giving this year a 22% probability with a higher chance of it occurring over the next 1 to 3 years. And Tasha Keeney has noted in the past that Tesla is building a dedicated robotaxi vehicle, so they're in a sense putting their money where their mouth is, since robotaxi has to come to fruition in order for this vehicle that's in development to actually function. So this shows the company's confidence as well. Cathie Wood and Tasha Keeney were also very impressed with this end-to-end demonstration from Holmar's catalog, where his car running the current version of FSD picked up and dropped off passengers without intervening with the vehicle controls, simulating how a future robotaxi would work. While it still needs to be perfected, especially in other states or other parts of the world outside of California where the concentration of Teslas is high, meaning there's a lot of data, the vision for the Tesla robotaxi network is certainly coming together, and ARK is valuing it between $200 to $600 billion of revenue over the next 5 years. Tesla is also working on their Dojo training supercomputer, which could accelerate the quality of full self-driving. And ARK Invest has also noted that new innovations in progress in the field of AI could also help Tesla reach full self-driving sooner. For instance, ARK notes that Tesla already uses transformers popularized by large language models for lane and intersection prediction, thus integrating the latest AI breakthroughs and research to help solve autonomy. One thing that's interesting is that ARK isn't modeling Dojo as a service or Tesla's Optimus humanoid robot in their valuation. In my TeslaBot video, I explain why Optimus does indeed contribute to Tesla's valuation today, but it does make sense that if they didn't include energy until now, they certainly won't include bipedal robots. That said, ARK seems to still include Dojo as a useful tool for enabling or enhancing full self-driving, just not as a separate service or business, as it's not yet clear what Elon Musk has in mind, even though he stated on the recent earnings call that if the Dojo long shot pans out, it could be extremely valuable. On the other hand, if Tesla can achieve robotaxis, the software for robots is fairly similar, so it might come shortly after, even if it takes Tesla some time to ramp up TeslaBot factories, although Elon Musk has demoed TeslaBots building themselves. Again, in my TeslaBot video, I argue that TeslaBots could be massive, potentially even larger than FSD, since if there's an app store that includes a wide variety of functionality, it could eclipse just transportation. Now, ARK Invest Brett Winton tackles the most cynical questions on Twitter, especially around ARK's Tesla valuation. And the model's available on GitHub and can be tweaked with different assumptions. And so in one scenario, if robotaxis are never deployed, Tesla's valuation drops to $900 per share. Still a significant increase from today, but down from the $2,000 per share expected value according to ARK. Or what if Tesla needs to be more aggressive on pricing, taking a 40% hit to gross margins? The expected value moves to $1,800 per share. And in a bear case scenario where Tesla faces pricing pressure and no robotaxi or any equivalent is launched, the expected value goes to $370 per share, slightly more than double from today's price over the next 5 years according to the model. And so one counterintuitive takeaway may be that instead of this valuation trying to model and predict where Tesla is headed, it may in fact help to influence Tesla itself, as Elon Musk replied to Brett Winton saying that this was an interesting thread, meaning that ARK's research may shed some light on some of the opportunities available and on how important robotaxis are as a future business, that it may inspire the employees and teams at Tesla to work to achieve these landmarks as quickly as possible. So given that robotaxis are the primary driver of outsized returns in ARK's valuation model, and then Elon Musk just said that it could be ready by year end, is Elon going to be right this time, or how far away do you think self-driving robotaxis really are given the progress of AI? Don't forget to watch my video on how Tesla's powering Apple's headquarters at Apple Park. Please hit the like button and subscribe, we would really appreciate that. And a huge shout out to all of our patrons that help to support our channel. Your support helps us to continue to make great content. Thank you guys so much for watching.